Thanks to the new viewers and returning subscribers for joining us once again in our lesson on investing. We hope to provide you with invaluable information to your satisfaction. Let us continue by learning about trading. Please consult a registered financial advisor for professional guidance. How to trade stocks. 6 steps to get started. Want to trade but don't know where to start? Trading stocks can be a fascinating and lucrative way for individuals to grow their wealth, but the stock market can be daunting for beginners. It involves complex strategies and online brokers and trading platforms with many tools available. New traders enter the market daily, but many fail to achieve their full potential because of a lack of knowledge, preparation, and proper risk management. The good news is that anyone can become a successful trader with the right knowledge, mindset, and approach. Some important takeaways. Newer investors should determine their trading style before diving into the stock market. Style is derived from one's personality, risk tolerance, time commitment, and financial goals. Decide on a brokerage platform that aligns with your trading style and offers the tools, resources, and support you need. Examine the stocks you might want to trade using fundamental and technical analysis to make informed decisions. Learn about order types. Understanding how each works, along with their risks and advantages, will help you make better decisions when placing trades. Create and stick to a strong risk management plan. This should include proper position sizing, stop-loss orders, and diversification. Number 1, decide what type of trader you want to be. It's important to choose your trading style before you begin trading. Are you interested in short-term trading, or are you looking at the long term? Do you have the time and dedication to be a day trader? Or would swing or position trading be more suitable for you? Consider your personality, your risk tolerance, and the time you can realistically dedicate to trading. This will help you find a trading style that aligns with your goals and abilities. Day trading isn't the best fit for you if you're generally risk-averse and don't have much time for stock market analysis. It requires constant attention to the markets during trading hours and making rapid decisions under stress. So it's not for the faint of heart. Swing or position trading is probably more suitable because they allow for longer holding periods and require less time commitment. There are 3 main trading styles. Day trading is where you trade the investment intraday, closing at the end of the trading day, with a high time commitment and high risk and volatility. Swing trading is where you hold the investment for a short period, days to weeks or months, with a moderate time commitment and moderate risk and volatility. Position trading, also called long-term trading, is where you hold the investment for a long period, several months to years or even decades, with a low time commitment and low to moderate risk and volatility. We've sorted the trading styles above based on how long an investor or trader holds onto the stocks. Day traders aim to profit from short-term price moves and typically close out all positions by the end of the trading day, so their trades are the fastest. Swing traders hold positions from days to a few weeks or months. They aim to capture short to medium-term trends. This style requires less time commitment than day trading, but it still involves being pretty engaged in the market. The third style is position or long-term trading. This is for those who hold on to stocks for several months, years, or even decades. These investors focus on long-term trends, and they may base their decisions on fundamental and technical analyses. This style requires patience and a long-term outlook with less frequent trading. There's no one-size-fits-all approach to trading. It's essential to choose a trading style that aligns with your personality, risk tolerance, and lifestyle. Important fact: you might find that your preferred trading style evolves as you gain experience and knowledge or your life circumstances change. After you've decided on your trading style, you'll need to find a good online broker and open an account. You'll want a platform that caters to your needs. Brokerages have different features and tools, and some are more suitable for your type of trading than others. Brokerages for day traders. A platform with quick speeds, real-time data, and advanced charting abilities is a must for day traders. These traders often require tools like Level 2 quotes that provide detailed liquidity information about the order book and hotkeys for rapid ordering. They may also offer automated or algorithmic trading options, triggers, and technical indicators. Customizable platforms like Interactive Brokers, TradeStation, and TD Ameritrade's thinkorswim are popular among day traders. Brokerages for swing traders. Swing and position traders should look for a platform with a wide range of indicators, research resources, fundamental analysis tools, and risk management features. These traders may also benefit from a platform that offers mobile trading apps that allow them to monitor their positions and trade on the go. Brokers like Charles Schwab, Fidelity, Robinhood, and E*Trade are well suited for swing and position traders because they provide a balance of research tools, user-friendly platforms, and competitive prices, typically with commission-free trading in most stocks and exchange-traded funds. Brokerages for long-term investors. A brokerage with a strong educational component and user-friendly interface is likely the best choice for long-term investors or those new to trading. Robo-advisors such as Betterment and Wealthfront can be good options for those who prefer a more automated approach to their portfolio. These platforms use algorithms to create and manage diversified portfolios based on the investor's risk tolerance and goals. Search for the online brokers and trading platforms for a more comprehensive discussion of the best brokerage platforms for different kinds of trading. A tip for you. Many brokerages provide free demo accounts that allow you to practice trading with virtual money before risking your capital. It's time to open and fund an account after you've chosen a platform that suits your trading style and needs. The process is straightforward and can be accomplished in minutes. First, provide your personal information. You must supply your name, address, date of birth, social security number, and other basic personal information. This is required by law to verify your identity and prevent fraud, so you can't avoid doing so by going elsewhere. Next, choose your account type. Brokerages offer several account types such as individual taxable accounts, joint accounts, and individual retirement accounts like traditional and Roth IRAs. Select the account type that best fits your trading goals and tax situation. Then complete the application. Fill out the online application. It may include additional questions about your employment status, income, net worth, and trading experience. This helps brokerages follow regulations and assess your risk tolerance. The information may also be used when you're applying for account features such as margin and options. Be sure to read and agree to the brokerage's terms and conditions that outline the services provided, fees, and your rights and responsibilities as a client. Finally, fund your account. You must deposit money before you can begin trading. It may take a few days for the funds to become available for trading after you've funded your account. The delay depends on the funding method and your brokerage's policies. Most brokerages offer several options to fund your account: bank transfer, wire transfer, and check deposit. Ensure that you understand the minimum balance requirements and any maintenance fees associated with your account. Some brokerages require a minimum initial deposit, or they charge fees if your balance falls below a certain amount. Here's an important tip. Search for the best online brokers and compare their commissions, research and analysis tools, ease of use, and reputation when reviewing brokers. Some sites offer online broker reviews to help you find the right broker. You should research the stocks you're interested in before you begin investing. This involves analyzing the company's fundamentals and the stock's price as it moves over time. Combining fundamental and technical analysis will give you far more confidence when you're finally diving in. Fundamental analysis. This approach best suits position traders and long-term investors. It involves evaluating a company's financial health, competitive position, and growth prospects. Review each company's financial statements to assess its profitability, debt levels, and liquidity. Look for companies with consistent and growing earnings over time because this can indicate a robust business model and effective management. Learn a bit about the company's industry and its position as you narrow your list of potential investments. What's its market share? Is this a sector set for growth? Don't forget to research the company's management team and track record. Technical analysis. Day traders and swing traders often use technical analysis. This involves studying past prices and volume data to identify trends and patterns indicating future price moves. You might look for recognizable chart patterns such as head and shoulders, triangles, and wedges. These price patterns reflect the behavior of market participants and can help signal potential trend reversals or continuations. Moving averages can help identify trends and potential support and resistance levels. You would employ oscillators such as the Relative Strength Index and Stochastic Oscillator to gauge momentum and identify when a stock is set to rise or fall. Many platforms provide these technical analysis tools. News and sentiment analysis. Monitor news and investor sentiment for the stocks that interest you. Review earnings reports. Earnings call transcripts will typically reveal specific areas of concern to investors. Look at management guidance, analyst ratings, and any geopolitical or macroeconomic events that could impact the company or its industry. Diversification. It's important to invest across sectors, market capitalizations, and geographic regions to manage risk as you build your stock portfolio. Diversification helps mitigate the influence of any single stock or sector that's underperforming. Continuous learning. Expand your knowledge by reading financial articles, stock market books, and website tutorials. Tune into Bloomberg TV and stay informed about market trends and economic indicators that could affect your holdings. Adapting to new information is essential for long-term success as a trader. Research and analysis is an ongoing endeavor. You may want to refine your research methods and develop a more personalized approach to stock selection as you gain experience and knowledge. It's also important to regularly review and assess your portfolio to ensure it aligns with your trading goals and risk tolerance. Here's a tip. Many brokerages offer extensive research resources and tools to help you analyze stocks and make informed trading decisions. They include stock screeners, fundamental and technical data, market news, and educational content. Place your order to buy or sell stocks. It's time to place orders with your brokerage when you've developed a trading plan and researched a range of stocks. You'll have to specify the stock ticker symbol, the number of shares you want to trade, and the type of order you want to use when you're placing an order. Market orders. These are the simplest type. You ask your brokerage to buy or sell a stock at the best available price. Market orders are executed quickly so you can be sure your trade will go through. You can get an unfavorable price, however, especially when there's lots of market activity or when you're dealing with stocks that don't trade frequently. Market orders are best used when you want to make a trade quickly and you're willing to accept the present market price. Limit orders. You set the maximum price you're willing to pay for a stock with these orders if you're buying, or the minimum price you're willing to accept if you're selling. Limit orders give you more control over the execution price, but they don't guarantee that your order will be filled. Your order won't go through if the stock never reaches your limit price. These orders are useful when you have a specific price in mind and are willing to wait for the market to reach that level. Stop orders. These are triggered when a stock reaches a specific price known as the stop price. The order becomes a market order and is filled at the next available price when the stop price is reached. Stop orders can limit losses on a trade or protect profits should your stock start to fall. Your order could be filled at a price significantly different from your stop price, however, in fast-moving markets. Order modifications and cancellations. You may be able to cancel or modify your order before it's executed, such as by changing the limit price or number of shares. But keep in mind that your order may be filled in fast-moving markets before you can do so. You must also specify the time and force when you're placing your order. This is how long it's active. Here are the most common options, along with their abbreviations that are offered by the best online brokers. Day order expires at the end of the trading day if not executed. Good till canceled, GTC, remains active until it is either executed or canceled by you. Immediate or cancel, IOC, must be filled immediately and any unfilled portion will be canceled. All or none, AON, must be filled in its entirety or not at all. Fill or kill, FOC, must be filled immediately and in its entirety or it will be canceled. This combines IOC and AON, market on open, MOO. A market order filled as close as possible to the stock's opening price, filled at the opening of the trading day. Market on close, MOC. A market order filled as close as possible to the stock's closing price, filled at the day's close. Important note. It's essential to double-check the details to avoid costly mistakes when you're trading. Ensure that you've entered the correct stock ticker, order type, quantity, and price, if applicable. Double-check that you have the correct number of zeros in the quantity, because buying 1,000 shares is 10 times more costly than 100. Be aware of any fees or commissions associated with your trades because these can affect your profits. Manage risk. You must manage your risk when you're finally up and running and real money is at stake. This involves identifying, assessing, and ranking potential risks to minimize their impact on your portfolio. You can protect your hard-earned capital, limit losses, and improve your trading performance by implementing effective risk management strategies. Diversification. Spread your investments across stocks, sectors, and asset classes. You can reduce the impact of an investment's performance on your overall portfolio by diversifying. This is especially important for long-term investors, but keep in mind that diversification doesn't guarantee profits or eliminate the risk of loss. Emotional discipline. Don't underestimate the importance of emotional control when it comes to managing risk. Fear and greed can significantly affect your trading decisions. Fear can have you exiting a position too early, and greed can cause you to hold on to a losing stock long after hope for a recovery is gone. You can make more rational decisions and avoid impulsive trades by managing your emotions and sticking to your trading plan. Hedging. For more advanced traders, this involves investing in a position to offset the risks they're taking with another trade, should the price not move as you expect. It's suited to more advanced traders. You could buy a put option to protect against a potential decline in the price if you own a stock. Hedging can be complex and involves certain costs, but it can be quite effective in managing risk. Position sizing. This refers to the number of shares or contracts you trade in relation to your account size. Proper position sizing helps you control your risk exposure and avoid putting too many eggs in one basket. A general rule of thumb is to risk no more than 1% to 2% of your account on any single trade. Risk-reward ratio. This compares the potential profit from a trade to the potential loss. A common risk-reward ratio is 1 to 2. You risk $1 to potentially earn $2. Maintaining a favorable risk-reward ratio ensures that your winning trades are larger than your losing ones, and this helps you achieve overall profits. Stop-loss orders. These critical risk management tools automatically close your position if the stock price reaches a preset level. You can limit your potential losses and protect your capital by setting a stop loss. Consider the stock's volatility, support and resistance levels, and your risk tolerance when you're placing one. A trailing stop is a type of stop loss that adjusts automatically as the stock price moves in your favor. This allows you to lock in profits while still limiting potential losses. The trailing stop loss moves up with it as the stock price rises, maintaining a fixed distance from the current price. Your position will be closed, securing your gains, if the stock price reverses and hits the trailing stop loss. Risk management is an ongoing process that should be regularly reviewed and adjusted. You can adapt your strategies as your trading skills, life circumstances, and economic conditions change. Prioritizing risk management is a must to protect your capital, minimize losses, and increase your chances of long-term success. Are there main differences between trading and investing? Investors are generally long-term buy-and-hold market participants. Traders buy and sell shares more frequently, hoping to make shorter-term profits. What are some common trading strategies? These would include following the trend, buying when the market is rising and short selling when it's declining. Contrarian trading, or going against the herd, scalping, and trading the news are also common strategies. Is technical analysis or fundamental analysis more important in trading? Technical analysis looks at the short-term picture and can help you to identify short-term trading patterns and trends, so it's ordinarily better suited to trading than fundamental analysis, which takes a longer-term view. What are the traits of a successful trader? In addition to knowledge and experience, discipline and mental fortitude are key. You need discipline because you're most often better off sticking to your trading strategy should you face challenges. Small losses can turn into huge ones without this. Mental fortitude is required in every trader's field to bounce back from the inevitable setbacks and lousy trading days. Trading acumen is another trait necessary for success, but it can be developed over the years as you gain knowledge and experience. In closing, start your trading journey by bringing yourself up to speed on the financial markets. Then dive into company fundamentals, read charts, and watch the prices to see if they meet your expectations. Test these strategies with demo accounts to practice trading, then analyze the results and make adjustments. You can research stocks after that and pick a brokerage to begin your first trades. That brings you to the beginning, not the end, of your investing journey. Before you go, we want to remind you to subscribe to this channel and show your appreciation for this invaluable information by hitting the like button to let others become aware of this content. Also, ensure you activate the notification bell to stay updated with the latest valuable investment information. Our goal is for you and others to gain invaluable information from this video. We hope you are gaining something from this, and if you are, just take 2 seconds, one to subscribe and one to like this video. It is a simple click for you, but a huge support for us, and it is completely free. It would mean a lot to us. Thanks.